Let's take the conversation forward. Manish, fantastic to have you back on ET now. Well, you've been arguing from last couple of months that crude will go higher, inflation will make a comeback, and it's time to exercise caution. Uh, Crude is at 85, commodity prices are in record high, and government is in a denial mode that inflation is transitory. What is happening?
Hi, Nikunj. Good morning. So, I mean, I'm not sure government is in denial, but yeah, to a certain extent, at least the world policymakers are somewhat overcommitted, uh, largely to do with the fact that, over last at least 2 decades, inflation has proven to be something which is very, very fleeting. And especially in last 10, 12 years, it's been very difficult for most policymakers to bring inflation back. So to that extent, I think, I think they're playing with fire, but they're being far too patient with this idea of inflation. And I've shared this with you in the past that it's very likely that they'll be proven wrong. And we should discuss as to why. But I think the conditions are set to ensure that inflation sustains at high enough level that eventually policymakers will end up sort of surprising markets somewhat nastily. So, which is why, purely as a risk investor, it sort of makes sense to be somewhat cautious.
I want to put context here for our viewers. Exactly a year ago, well, not exactly a year ago, let's say in September, Manish made a very strong call that it's time to buy into small and mid cap stocks. The reflation trade was making a comeback. That time, the scenario was demand had got crushed, and we were dealing with peak corona crisis in the world. Now, the situation is very different. Now, confidence is back, vaccination numbers are ensuring that economies are opening up, but record levels of commodity and food prices is something which cannot be ignored. Manish, there is a level at which you would say inflation comeback is healthy because it gives pricing power back. Have we gone beyond that healthy mark of inflation because some inflation is necessary?
Absolutely, at least in developed world, it's a welcome thing that inflation is returning. But Nikunj, remember this inflation is it not just the demand side; it's also supply driven. And what we're experiencing, Nikunj, is in a post-COVID world, two big forces, somewhat independent, working on the world economy and creating inflationary impulse. One is that the post-COVID economy is different. It has more demand for goods than world could produce, and to that extent, the goods economy is overwhelmed. The stuff that we buy at home, we want much more of it than we wanted before COVID. So to that extent, there is a demand supply mismatch more driven by higher demand that supply can't meet. On the service economy side, while the demand is still much below what do you call it before COVID, yet because of the COVID protocols, the supply is constrained, restrained, and to that extent, even at lower level of demand in the service economy, you sort of seeing demand supply mismatches resulting in shortages. So what you're seeing in at ports and stuff like that, you go to airport and you see while the PLF numbers are still low, airports are getting overwhelmed. So that part of a force, which is demand supply mismatches or imbalances, actually is creating inflationary impulse. It's not a very welcome thing because it means that at some point in time we'll have to tame demand just to ensure that the demand supply mismatch does not result in higher inflationary expectation and durable inflation, so to say. So that's one part of the story, Nikunj. I just want to sort of bring in another story, which is energy storage, energy shortages rather. And now that is sort of independent of COVID, Nikunj. And what's happening, of course, is that many years of underinvestment has resulted in this situation where the old sources of energy, we can't get enough of it. And, given that, demand has recovered meaningfully, you're seeing demand supply mismatches on the energy side. So both of these forces, one is on the demand supply of the goods and services, and then there is this energy shortages. Both of them are resulting in a situation which actually is quite malevolent. It's not necessarily something that is good and welcome by anyone. And unfortunately, there is no solution to it, Nikon, very likely that you'll have to tame demand at some point in time to ensure that this inflation does not become pervasive and actually becomes headache for common people and policymakers.
I'm just going to take that point forward from Manish and simplify it for our viewers. Manish is saying that, folks, energy prices have gone higher. There are serious disruptions which are happening to supply chain. Demand is coming back, and it's not that tomorrow morning, it's not like a Jack in a beanstalk moment that tomorrow morning the world will move away from fossil fuel. Fossil fuel is here, and it will be here for some more time. And the world is going through an energy shock, which is you'll have to increase interest rates to bring the demand down. Okay, Manish. Now let's understand what an investor should do. High inflation means lower returns for equity because future discounting comes down. Higher inflation means interest rates will go down. Bond markets will not give returns. What should an investor do? Because FD returns are low, bonds are not going to give you good returns, and equity returns will get capped.
So, Nikunj, I sort of follow a cycle investing approach. The first phase of cycle, is what I argued with you since end of March 2020, which sort of lasted until August of 2021, was a reflation trade, and that's when investors make huge tons of money in equity on all sorts of risk asset. We've actually entered a mid-cycle in which policymakers sort of begin to restrain economy. At least they don't stimulate economy, but the restraining part is well telegraphed one, meaning they sort of tell policymakers like RBI, Fed will tell you that they'll tighten rates, and so to that extent it doesn't really matter much to the asset market. Now what's happening, Nikunj, is that because inflation is misbehaving to a certain extent, and shortages are all across, it is likely that we can sort of quickly move from mid-cycle to end of cycle period, let's say in 6 to 12 months time. And remember that in end of cycle, in equities and other risk assets, you actually end up losing money. So while it's not my base case yet, and as I argued last time with you in July, August also, that the time is now to move away from small and mid caps, hide yourself in, let's say if you're a risk investor and a compulsive investor, move yourself in sort of nifty and sort of large cap oriented mutual funds, if at all, and sort of wait out, be underweight equity, because that's the only way you can be overweight in reflationary time. But now be aware that in case inflationary impulses consistently surprise markets, it will eventually mean that markets will be surprised by policy actions also, and would also mean that they won't like it, and will have sort of sell-off coming in at certain intervals. So as such, this is a period of sort of not significant returns in any asset class. Bonds, of course, is absolutely no. Fixed deposit bonds, they are all no. Commodities look expensive. Equity is the only place where you can actually hide in mid cycles. But remember that don't have FOMO, don't have too many expectations from equity. The expected returns from equity in real term at least will be lower. But given that we are quickly or fast approaching the end of cycle the symptoms as far as business cycle is concerned, be aware that if that plays out, you'll have to sort of reduce risk further, and even trim the Nifty oriented or S&P oriented exposures that you have. That's the sort of approach I'll follow as far as investors are concerned.
Maneesh, are you in any way hinting at the bull market peaking out, or would you say this is just going to be a temporary lull in an otherwise roaring bull market?
Hey, so I mean, bull market, as far as returns bull market is concerned, the obscene return that you made, small cap pretty much tripled in 17, 18 months in India. So, of course, the tangent will be different now. You'll have relatively lowish returns, so to say. Nominal returns, in the inflationary backdrop that we have, of course, will continue to be okay, but not great, so to say. I would be surprised if it is an end of bull market, because that would mean that we sort of had 2009-10 like business cycle, which sort of ended within 1.5 2 years. My bet is that at least in India, this would be longish, and this mid cycle would persist for 1 2 years at least, if not more. You will have lowish return, but a reasonable and okayish return, let's say in Nifty. You will have less and more volatile returns in small and mid caps. But again, you never know about markets. If policymakers begin to surprise you by tightening rates because they begin to fear inflation a lot, we should sort of prepare ourselves for end of bull market as well. But at this stage, I'm not calling it out. I think there is a reasonable space in the world economy and Indian economy to grow, and that means that there'll be undercurrents of more gains, so to say, in asset prices.
Wow, Manish, I must say that you're the first of the lot to actually say that on record. But point taken, I get where your fear is emerging from. The other aspect, Manish, like you were earlier alluding to, is if you go underweight equities, where do you invest? Fixed income is not giving you return. Gold hasn't had the best of the ride as it did in 2020. So where do you park your money? You can't be sitting on cash.
Absolutely, absolutely. Fixed income is not a place to go to. I mean, especially duration assets. If you are fearing inflation, you ought to be out of duration. But remember, equity is the longest duration product. The long bonds, of course, are duration. So you ought to sort of hide yourself in, short duration, like 3 months, 6 months, 1 year assets. But there, the real returns are actually negative. Something that cannot scale up in a significant manner, but to your audience, it could mean a lot, is buy farmland, because that gives you the best protection for inflation. Gold and silver have sort of independent cycles, but I think there could be some steam there. Again, you can't have significant exposure to gold and silver as a percentage of a portfolio. So broadly speaking, you still have to be at least equal weight risk assets, but you have to diversify now. Some of it could be, as I said, to real estate, more specifically farmland. Some of it could go to gold and silver. And then, of course, you have to sit on, what do you call it, equity mutual funds or equity-oriented exposures. But again, just be aware that if it is an end of cycle, you ought to be sort of careful and quickly trimming the exposure even on the large cap Nifty oriented exposure at some point in time.
Buy farmland. Manish, you're giving us a headline after headline. Is that your farmland that you're sitting at? I see that it's not a regular
Yeah.
home
Literally,
backdrop. You're out in the open
I'm
somewhere.
literally I'm literally at a farmland. I mean, actually, I've been actively looking out for one sort of pieces of land. As a matter of fact, it's also an asset class, and over last couple of years, especially after 2014, equities have actually significantly outperformed farmland. As such, the whole of real estate sector has had 6-7 years of lull. I think if I compare this, and we should have a conversation independent, at least at some point in time, that farmland in India is at least at relative to any time in the past in last 15-20 years, especially after 2004, is actually quite cheap relative to financial assets. And you get a reasonable rental yield or farm yield, so to say. I'm also sort of very bullish on farm prices, and as such, the agri sector in India should do really, really well. So I would advise that people should buy farmland if they can. Otherwise, as I keep saying every time to Nikunj and you, that the first asset that you must buy now, given that relatively they are cheap, is your own house. Farmland is a big thing, but at least you must buy a house because they're relatively cheap relative to at least financial assets.
Yeah. Well, when you live in Mumbai, actually farmland is cheaper than your own home. But that said, Manish, all things aside, valuations is just, one beast of the stock market. You can't take away from the demand surge. You were saying that you were at the airports and you're traveling to your farmland, wherever you are right now. When you go out, when you go at restaurants, when you go to malls, it's like the pandemic doesn't exist at all. Demand is something that you cannot, move away from. What happens to the earnings cycle? I mean, the earnings cycle is not going to peak out, right? Companies will continue to churn demand and they will continue to post the kind of profits that they have, not the inflation sensitives, of course. Are those companies also
Absolutely.
perhaps decent spaces to perhaps hide in whenever the correction sets in?
Yeah, I mean, firm specific and sector specific, there are independent cycles, but there's something called beta, and it, unless of course the broad markets are in good shape, good or bad sector all tend to underperform bonds, let's say, as far as equity is concerned. But I agree that the bottom up stock pickers could always identify sectors and firms which would do well. Let's say if sort of policymakers begin to tighten again. But again, just to sort of step back, to give you, at least from a macro point of view, at least I approach markets in terms of cycles. Early cycles are the periods where you make humongous returns, and those are the parts of a cycle when news is bad, but policymakers are hyperactive in stimulating demand or creating more supply. And that ensures that very large returns of equity markets are actually generated in that part of the cycle. Now that part is over. We also call it reflation, which basically mean that policymakers are trying to reflate economy. Then we enter in mid-cycle where while policymakers are restraining, but overall earnings cycle has picked up and demand is actually chugging along well. And that is an independent of policy, equity market do reasonably well. But remember, large part of the excess returns have already come in the reflation trade. And then mid-cycle eventually gives into late cycle, in which you will have a policymaker surprising you on tighter side, trying to restrain demand significantly that markets don't like. And of course, markets, actually lose money in that period. We are in mid-cycle, as I said. This is a period you will perhaps over next 1 or 2 years make excess return over bond, but not significantly higher. Okay. So if with that perspective, given that early cycle of the reflation trade is already behind us, it makes sense to be either equal weight or underweight equity. So if you follow a macro approach of investing, as I do for myself and my investors, you will have to trim exposure in equity so that you prepare for a late cycle complete exit of equity. That's the approach I follow. But a lot of fund managers and fund houses will tell you, and that's true for an average guy, and I've told this to Nikunj many times, that if you're not an active investor of timing it, then you sort of stay invested and keep allocating money to Nifty, and you will do a reasonable job in next 10, 20, 30 years. But you don't necessarily have to time it. So with that approach, the systemic investing, SIPs and stuff like that, can continue as we move forward, irrespective of how the cycles are playing out.
Manish, so great to have you on the show, and what a refreshing backdrop. I hope you get to select your farmland soon.
Thank you very much.